The global economy is once again treading on slippery ground after having navigated the major challenges of the pandemic and the inflation crisis. It now faces weak growth and increasing investment needs, which clash with higher and more expensive sovereign debt, showing no signs of easing. The broader environment is also unhelpful. Central banks have adopted restrictive monetary policies, and geopolitical and macroeconomic uncertainties are disrupting markets. This is highlighted in the latest report from the Organization for Economic Cooperation and Development, OECD, which warns that, in aggregate terms, the debt volume of the bloc's countries reached 84% of GDP in 2024, $55 trillion, and this year it will rise to 85%, about 10 percentage points higher than before the health crisis and nearly double the level of 2007. The United States debt has surpassed $35 trillion, raising concerns about the global economic consequences. In this context, the International Monetary Fund, IMF, has urged authorities in the world's leading financial power to take action on the issue. During the IMF and World Bank annual meetings in Washington, IMF economist Peter Gasper stated, "This cannot go on forever." He also referenced the upcoming presidential election on November 5th, calling on the next president to implement decisive measures to avoid a global crisis. Debt reflects the amount of money the federal government owes to creditors, both domestic and international, and is concerning because it signals a high and ongoing level. On this topic, analysts from the financial newsletter The Kobayashi Letter noted that the debt increased by $473 billion in the past 3 weeks. This means that the United States has taken on $1,450 in debt per American, just in the past 3 weeks, they emphasized, adding, "Unsustainable is an understatement. Something has to change." The high level of debt means the U.S. government must raise taxes and cut public spending in key areas like healthcare, infrastructure, or education in order to allocate those resources to interest payments. These measures could limit the economic growth of the world's leading financial power. If investors see the debt continuing to rise despite a package of measures, they may demand higher interest rates to finance the U.S. government. The equation is simple. This will inevitably lead to even greater debt and a significant rise in interest rates, making credit more expensive for households and businesses. According to the Kobayashi Letter, the budget deficit increased to 6.3% in Q3 of 2024, up from 5.6% in Q2, a new yearly high. In other words, the U.S. is spending more money than it collects in a fiscal year through taxes and other revenues. To cover that gap, it borrows, and the debt continues to grow relentlessly. In the chart below, the unemployment rate, blue curve, and the budget deficit, red line, are shown, along with a red circle indicating that the deficit rose by 6.3%. Spain is not exempt from this dynamic. Its debt ratio has declined from the peaks reached during the pandemic but remains high, above 100% of GDP. France, Spain, the United Kingdom, and the United States face greater vulnerability, the multilateral organization warns. The OECD notes that the debt maturing in 2027 in these 4 countries represents more than 15% of their current GDP, and refinancing will increase interest payments by approximately 0.4 percentage points of GDP by that time, when nearly half of the club's sovereign debt will mature. In other economies within the bloc, the projected average increase will remain below 0.2 points. This combination of higher costs and greater debt risks limiting future borrowing capacity at a time when investment needs are greater than ever, concludes the 2025 Global Debt Report, Financing Growth in a Complex Debt Market Environment, published this Thursday. Indeed, the scenario is complex, with risks everywhere fueling uncertainty. With debt already at high levels, the rise in interest rates has made new loans more expensive and will complicate refinancing. Meanwhile, a potential 180-degree shift by the U.S. under Donald Trump, both diplomatically and commercially, through the launch of a trade war, threatens to reignite inflation and stall an already weak global recovery. On top of all this are the massive investments needed to drive the digital transition and combat climate change, as well as to finance the arms race many countries have joined amid a heated geopolitical landscape, with the war in Ukraine at the center of tensions in a new, less predictable, and more fragmented world order. Given current conditions, meeting these needs will require recommends that governments adopt greater fiscal prudence, structural reforms to boost growth, and more efficient public spending, while urging companies to prioritize debt for expenditures that enhance productive capacity. Both sovereign and corporate debt increased last year and are expected to continue on an upward trend in 2025. In fact, last year alone, money borrowed by governments and corporations in global markets exceeded $25 trillion, 3 times the amount in 2007. This increase is largely attributed to the financial crisis followed by the pandemic, both of which disrupted economic activity and required fiscal stimulus to avoid a deeper recession. Stricter banking regulations also encouraged a shift toward market-based financing. The OECD forecasts that sovereign bond issuance by member countries will reach a record $17 trillion this year. According to analysts, this borrowing reflects efforts to protect employment in the United States and avoid a recession. In other words, without the additional spending, unemployment might have risen to levels similar to those seen during the COVID-19 pandemic. Debt is not only larger, it's also more expensive. While much of the outstanding debt was issued during a period of ultra-low interest rates and remains relatively low cost, central banks have since raised rates and adopted restrictive policies to counter the inflationary spiral triggered by the war in Ukraine and supply chain disruptions. As new debt must be refinanced, costs will increase. The rise in financing costs is already weighing on public finances, summarized OECD Secretary General Matthias Cormann during the report's presentation. Monetary authorities have also begun retreating from the markets after absorbing large amounts of debt in recent years. In OECD countries, their share in sovereign bonds dropped by 10 points between 2021 and 2024, from 29% to 19% of total outstanding debt. The withdrawal of institutional investors implies that more lenders must step in or existing ones must acquire more debt. The figures show that households and foreign investors are covering the shortfall. Household participation rose from 5% to 11%, and that of foreign investors from 29% to 34% over the past 4 years. According to the OECD, the risk is that this dynamic could unravel in a more volatile context. Rising geopolitical tensions and trade uncertainty could trigger a sudden surge in risk aversion among these investors, warned Cormann. At the end of last year, real 10-year yields exceeded the 2015 to 2019 average in nearly all OECD countries, and between 2021 and 2024, interest payments as a percentage of GDP climbed from their lowest to their highest levels in 2 decades. Increases in interest payments tend to be gradual, since total outstanding debt is issued over decades, the organization explains. Nonetheless, nearly 45% of OECD sovereign debt will mature by 2027. It calls for smarter debt strategies. While the era of ultra-low interest rates allowed for prioritizing financial operations, the current moment demands channeling credit into projects that boost productivity. The key lies in balancing financing needs with long-term sustainability. The path to net zero emissions will look very different depending on whether the public or private sector bears most of the investment burden, the OECD warns. If governments alone drive the change, debt-to-GDP ratios could increase by 25 percentage points in advanced economies and up to 41 in China by 2050. In other emerging markets, the rise would be 16 points by 2040. If the private sector bears the bulk of the responsibility, it too would accumulate excessive debt, and the bond market for energy companies in emerging markets, excluding China, would need to quadruple in size within a decade. If public and private investment growth rates in the climate transition remain in line with recent trends, advanced economies won't align with Paris Agreement targets until 2041. The situation is even more difficult for emerging markets, except for China, which face an investment shortfall of $10 trillion to meet their 2050 goals. The United States does not face difficulties financing itself thanks to the strength of the dollar as a reserve currency. However, a rise in interest rates due to high debt levels has global repercussions. Many countries, especially developing ones, hold reserves in US dollars, and any uncertainty could spark concerns about the currency's stability. An increase in debt without a proper management plan fuels greater volatility in global markets. A loss of confidence in the dollar as a reserve currency could push countries to turn to alternative assets like gold or Bitcoin, BTC, during times of economic uncertainty, high inflation, and a desire to avoid direct exposure to U.S. government decisions. Governments are forced to prioritize debt repayment over investments in public services and development, and it's people who pay the price: underfunded schools, hospitals with scarce supplies, and crumbling infrastructure. However, due to ineffective and costly debt restructuring mechanisms, most governments avoid default at all costs, even if it means sacrificing development and climate action. As a result, countries may be current on their debt, but in default on development. In 2023, 54 developing countries, nearly half of them in Africa, allocated at least 10% of public revenues to interest payments. Today, 3.3 billion people live in countries that spend more on debt service than on health or education. If you found this content helpful, don't forget to subscribe to this channel and give this video a thumbs up. See you soon.